Do you hear that? Stop what you are doing, put down the phone, close the other tabs. That isn't just market noise. That isn't the hum of the trading floor. That is the sound of a countdown clock attached to the foundation of the entire US economy. Ladies and gentlemen, we need to have a serious conversation about risk. Not the kind of risk CNBC talks about which stock is up or down 1% today. I am talking about systemic risk, the kind that wipes out a decade of wealth in 6 months. The Shiller P/E ratio for the S&P 500, the one metric that strips out inflation, strips out the noise, and tells the mathematical truth, has just smashed through 40. Now, if you are a casual investor, you might see that number and shrug. So what? Stocks are expensive. They've been expensive for years. You need to understand the gravity of this data point. The historical average of the S&P 500 is roughly 17. We are not just trading at a premium. We are trading at a statistical outlier, a standard deviation so extreme that it has only been triggered twice before in the history of American capitalism. This is not just a cold, boring statistic. It is a flashing red siren. It is a 5-alarm fire in a crowded theater. It is a mathematical impossibility waiting to correct itself via a violent mechanism known as mean reversion. If you are holding a standard portfolio right now, if you are long only on the S&P 500, you are not investing. Let's call it what it is. You are driving 200 miles per hour on black ice without a seatbelt. You might feel safe because the car hasn't crashed yet, but the laws of physics and the laws of financial gravity apply to you, whether you acknowledge them or not. There is a phrase on Wall Street that kills more portfolios than any other. This time is different. It is the siren song of the amateur. Let's take a walk down memory lane to see just how different things really are. Go back to 1929, the eve of the Great Depression. We look back at those investors as naive, don't we? But they didn't think they were naive. They had radio technology. They had automobiles. They had a new economy. Productivity was skyrocketing. The mood was euphoric. And what was the Shiller P/E ratio the moment before the bottom fell out? It was 30. Just 30. And that valuation level was enough to trigger a deleveraging event that liquidated 89% of the market value and destroyed an entire generation's future. Now, fast forward to 2000, the dot-com bubble. I remember this era vividly. The narrative was identical to today. The internet changes everything. Valuations don't matter because growth is infinite. We had companies adding .com to their name and doubling in price overnight. It was the era of irrational exuberance. And yes, the internet did change the world. It revolutionized everything, but the investors still got slaughtered. The Nasdaq lost 80% of its value. 80%. Amazon dropped 90%. Cisco and Intel took 15 years to recover their highs. And what was the P/E ratio right before that implosion? It peaked around 44. And where are we today? We are sitting at 40. We are dancing on a cliff edge higher than the Great Depression and statistically identical to the absolute peak of the dot-com crash. The market is a pendulum. It swings from fear to greed. Right now, the pendulum is stuck at maximum greed. But when gravity takes over, it doesn't just swing back to the middle, it swings to maximum fear. Now, I want to explain why the crash happens. It's not just about expensive stocks, it's about market structure. Look at the market. Does it feel stable to you? Or does it feel like a fever dream? Real estate, stocks, crypto, watches, art, every asset class is correlated. Everything is up. This is what we call an everything bubble, fueled by years of cheap money. When you log into your brokerage account and see those green numbers, you feel a sense of wealth. But you need to understand the concept of liquidity illusion. In today's market, trading is dominated by passive ETFs and high-frequency algorithms. When money flows in, prices float up effortlessly like a balloon. But liquidity is a coward. It disappears when you need it most. When the trend reverses, the algorithms pull their bids. The buyers vanish. And suddenly that wealth on your screen, you can't monetize it. Because to sell, you need a buyer. And at P/E40, when panic starts, there are no buyers. You are being set up to be the exit liquidity. This is a brutal term we use in the industry. While you are buying Nvidia and Microsoft at all-time highs because of FOMO, fear of missing out, who do you think is selling it to you? It's the insiders. It's the hedge funds. It's the smart money. They are analyzing the same data I am showing you. They're handing you the heavy bags and walking out the back door before the building catches fire. You are trapped. It's not that you don't want to sell, it's that you're scared to sell. You are terrified of missing out on the last 5% of the rally. But professional investors, we are terrified of the drawdown. We know that if you lose 50% of your money, you need a 100% gain just to get back to zero. Preserving your capital is mathematically more important than chasing the last dollar of profit. So what is the solution? Do you panic sell everything, buy gold bars, and go live in a bunker? No, that is emotional reacting, not intelligent investing. You need a strategy that acknowledges the risk but keeps you in the game. I call this strategy the Iron Shield. We are going to pivot your portfolio away from hope and hype and toward math and survival. I have selected specific ETFs that act as defensive fortifications. And I'm not just guessing. I'm putting these through the acid test. We're going to look at how they performed in 2022, the year cash died, the year both stocks and bonds crashed. I want to show you how these assets stood like granite pillars while the rest of the market turned to dust. First up, the absolute baseline of human existence. If the economy implodes tomorrow, if the grid goes down, if the credit markets freeze, what does humanity still need? I don't care if it's the zombie apocalypse. As long as people are breathing, there are things they cannot live without. This is our first line of defense, consumer staples. The tickers are VDC, Vanguard Consumer Staples, and XLP. I'm not talking about the new iPhone or the Tesla Cybertruck. Those are cyclical. Those are nice to haves. When you lose your job, you stop buying that junk. I'm talking about Procter, Gamble, Costco, Walmart. Think about it. No matter how much money you lost in the stock market this week, did you brush your teeth this morning? Did you wash your clothes? Does your family still need toilet paper, food, and soap? Yes, you literally cannot cut that budget. When the economy tanks, people don't stop shopping. They just trade down. They flock to Costco to buy bulk beans and rice. These businesses have the holy grail of investing, pricing power. Inflation is 10%? Who cares? They raise prices 10%. You'll pay it. You have to pay it. Let's look at the scorecard, the acid test of 2022. The S&P 500 fell 19%. The Nasdaq was a bloodbath, down 33%. But what did VDC do? I want you to really hear this. VDC ended 2022 basically flat, 0% change. Next, the second wall of the fortress. This one is boring. It is unsexy. It is the opposite of a meme stock. Utilities. The ticker is FUTI. I know, utilities. It sounds like dead money, but when you are standing on the ledge of a 40 PE market, boring is beautiful. We are talking about NextEra Energy, Duke Energy, Southern Company. The companies that run the power grid and the water pipes. Ask yourself this: if the stock market crashes tomorrow, are you going to call the power company and say, hey, cut my lines, I need to save money? Are you going to stop flushing the toilet? Are you going to freeze in the winter? No, you will sell your car, you will sell your watch, you will sell your kidney before you turn off the lights. These are government-regulated monopolies with guaranteed revenue. But here is the macro alpha. There is a massive tailwind for this sector that nobody is pricing in correctly: artificial intelligence. Everyone buys Nvidia for AI, but what does AI need to run? Data centers. And what do data centers need? Power. Massive gigawatt scale amounts of electricity. The US power grid is maxed out. Demand is skyrocketing. The utility sector is the pick and shovel play of the AI revolution, but without the valuation risk of the tech sector. The acid test. 2022. Rising interest rates are supposed to kill utilities, right? That's what the textbooks say. Well, the textbooks lied. While the S&P tanked 19%, FUTI was up 1.6%. Positive, green. In a sea of red blood, FUTI was a green island of profit. That is a miracle. That is defying gravity. Now, we complete the iron triangle. Survival itself, your biology, healthcare. The ticker is XLV. The offense, demographics. The world is getting old. The baby boomers are entering their high care years. We have a tsunami of elderly people who need pills, surgeries, and care. XLV holds the titans: United Health, Johnson & Johnson, Eli Lilly, Merck. We are talking about companies curing cancer and selling Ozempic to the entire planet. The 2022 stress test. The market crashed 19%. XLV down only 2%. A scratch. A mosquito bite. If you need some growth potential but refuse to take the risk of tech valuation, XLV is your sweet spot. Okay, those are the sectors. Now I want to give you the special forces, the factor strategies. First, SCHD. Burn that code into your brain. SCHD. Listen, the name dividend equity is misleading. There are a lot of trash dividend ETFs out there. They are yield traps, buying dying companies just because they pay a high percentage. SCHD is different. It is an elite club. It focuses on the quality factor. To get into SCHD, a company must have a 10-year history of paying dividends. But critically, it screens for free cash flow and return on equity. It kicks out companies with too much debt. What are you left with? The absolute highest quality businesses in America. Home Depot, Chevron, PepsiCo, BlackRock, the ones that print cash. Why is this critical? Because in a bubble, people buy stories. But when the bubble pops, stories are worthless. Cash is king. When liquidity dries up, only the companies that actually generate cash can survive. SCHD is a fortress of cash flow. Second, USMV. For those of you with weak hearts who can't sleep at night, USMV. This is a math nerd's dream. It uses an optimization algorithm to scan the market and build a portfolio of stocks that historically move the least. It hates drama. It picks the most boring, steady Eddie stocks it can find to minimize beta. So there you have it, the armory. VDC, XLP, FUDI, XLV, SHD, USMV. These are your survival kit. But I know what you're thinking. The little voice of greed is whispering in your ear. But what if the market keeps going up? What if I miss the rally? What if AI sends the S&P to 6,000? Stop. If you are thinking that, you are the retail bag holder. Are you really going to risk your entire financial future for the chance to squeeze out another 5% gain on a parabolic chart? Do you know what happens when a bubble pops? It's not a slow leak, it's a rug pull. The algorithms trigger, the liquidity vanishes, and the bid side disappears. You watch the price free fall, you freeze up, and you end up selling at the bottom. I've seen it happen too many times. I'm not telling you to panic sell everything and go live in a cave. I'm telling you to learn the art of sector rotation. This is what the pros do. Take your profits on those tech giants that are up 300%. Trim them, take that house money, and rotate it into SCHD. Rotate it into VDC. Lock in the win. Picture this. It's 2 years from now. The news is apocalyptic. CNBC is talking about the Great Reset. Your buddies are crying into their beers because their portfolios are down 60%, and you're down maybe 5%. Your dividends from SCHD are hitting your account, buying more shares at cheap prices. You are calm. You are secure. You will look back at this moment and you will thank yourself for having the guts to be boring. This is a game of survival. It's not about what you make in the boom. It's about what you keep in the bust. Do not wait until the house is burning down to buy a fire extinguisher. The PE is 40. The alarm is ringing. Just survive.